Hello and welcome to this fresh new edition of MF Corner. I'm Sonal Bhutra and with me is Ekta Batra. Well, you know, Ekta, at a time when investing and markets actually are at an all-time high and it's buoyed by so many flows across all the categories, the question that we've been getting a lot from our viewers is it a good time to look at multi-asset funds? What makes this category an alternative to debt funds or, say, balanced advantage funds? So a lot to discuss and we have the guest for that as well, Ekta.
Hi Sonal. Yes, absolutely. You know, what kind of asset class, whether there should be any kind of diversification strategy. So we have a lot to discuss in the next 20-30 odd minutes. On that note, let's welcome Amit Bivalkar, who is the founder and director at Sapient Wealth Advisors and Brokers, to talk about multi-asset funds. Welcome to the show, Amit. Thanks very much for joining in. Well, the first question is, which we've got is that Indian equities have touched record highs. Does it then make sense to invest in multi-asset funds in that case in order to diversify your portfolio?
Okay, first of all, these all-time highs are on a daily basis now. So we should say that market is at a new high. And in the last 20-25 years, whenever we have seen such exuberance in equity, you have seen more and more people actually coming into equities. We have always said that asset allocation should not be dependent on market levels, but it has to tie with your risk profile. And every investor has to actually look at his own risk profile, and he should have his asset allocation in place. So it's not so that if the market is at a new high or an all-time high, then you should consider multi-asset funds. But asset allocation, you can do it through equity, through debt, through gold, by investing in different funds. Or if you want all in one, then you can definitely look at a category like a balanced advantage or a multi-asset fund.
Okay, so we will discuss that, of course, in greater detail, Amit. But what is the allocation like in multi-asset fund? Do they need to have a minimum amount in every asset class?
So what SEBI has mandated is that you need to have 10% in three asset classes, three different asset classes. And these are typically debt, equity, and precious metals. Why I'm saying precious metals? Because there are some funds who have gold as an asset class there, and there are some funds who have recently introduced even silver arbitrage as a category there. So you have got 10% minimum what you need to invest in debt, equity, and precious metals. But for taxation purposes, if you want to look at a debt taxation with indexation, this is the asset class now. This is a type of fund which has got the debt indexation available if you are at 35-36% of equity and the rest in debt. So when in the April of 2023, you have indexation which went off from debt mutual funds. Multi-asset as a category still offers you indexation benefit on the debt portfolio. And therefore, many people are also looking at this category, Sonal. And therefore, people are looking at this category with the exposure of minimum 10% in equity or in debt or in precious metals, to be specific to your question.
Okay, all right. But Amit, you know, just to ponder on this point in terms of diversification as well as comparison, is this a great way to diversify from, say, debt funds because of the indexation benefit being taken away, or they're not comparable?
I think you have to look at the risk in the portfolio. If you look at a couple of funds, multi-asset as a category has three different types. One multi-asset fund or the category of multi-asset funds that we look at, which are quite popular in the market, they have a naked equity exposure. So you definitely have equity risk coming along with that. If you look at some of the multi-asset funds, they have got prominently arbitrage and debt as a combination there. And the third category, which Fund House has come out with, wherein they are not buying any net equity, but what we are doing is they are buying arbitrage, they are buying debt, and they are buying silver for arbitrage purposes. So you can't really say that you have replacement of debt by investing into multi-asset funds. Typically, in a debt fund, an investor comes in for parking his short-term surpluses Earlier, before March, people have invested into debt funds to take advantage of the indexation benefit so that you get the indexation benefit if you stay beyond 3 years. But after April, this indexation benefit is withdrawn. So if you want a pure debt fund play, then there is only, I think, one multi-asset fund which does not take equity exposure, and that can be straight away compared to a debt fund. Otherwise, most of the multi-asset funds, they do have a equity risk, and therefore this cannot be compared with a pure debt fund in play.
Okay, so not really comparable because a lot of other factors are concerned or considered as well while investing in different categories. But is this a high churn category? Say during low interest rates, do they ensure higher allocation in debt during times like this in equities and maybe during safe haven buying in gold? Do you see extra or increasing churn here?
Yeah, so the beauty of this product is that they say a minimum requirement in each asset class, and you have a dynamically asset allocation model which is at play in this category, wherein if you have equities at highs, then the fund manager moves to either a debt or a precious metal portfolio. If you see opportunity of making money in debt, if you have a view that the interest rates are going to come down, then you actually play the debt portion. And if you are at a high inflation kind of scenario, then you actually go in for gold. So typically, Sonal, equity is used for capital appreciation, while debt is morely used for accrual purposes, while gold as an asset class is always used as an inflation hedge. So depending on the fund house view and the fund manager's view, these guys definitely move within the asset classes. The biggest advantage though here is that even if they move within the asset class, the investor does not pay any tax. And I think that is the most important aspect when it comes to multi-asset. The fund manager adjusts the portfolio depending upon the interest rate scenario, the economic scenario, as well as the inflation view. But while doing so, the investor actually does not pay any tax because it is happening within the fund. And I think that is the biggest advantage of a multi-asset category.
Okay, all right. So one of the biggest advantages of a multi-asset fund is that there is movement within the fund of asset classes and one doesn't have a tax liability on that. So that's probably the key differentiation or the key interest point when it comes to multi-asset funds, and it provides diversification as well. Well, Amit, hold on. We need to take a quick break, but on the other side, we'll continue our discussion with Amit Bivalkar of Sapient Wealth Advisors and Brokers on multi-asset funds. Stay tuned. Welcome back. You're still tuned into MF Corner on CNBC TV18. We still have with us Amit Bivalkar to talk about multi-asset funds. Well, Amit, another question with regards to multi-asset funds. How exactly does the benchmarking of such funds take place then, since there are so many asset classes within the fund?
Right, so various schemes have different benchmarks, and that's a combination of various benchmarks which have come into play here. If you look at some of the funds, they have a 65% Nifty 200 with a 35% or a 25% CRISIL short term, plus a 10% gold price index, which comes into play. There are some which have 35% Nifty, there are some with 50% Nifty. So it's depending on the objective of the multi-asset scheme that you are investing, that you have got a combination of all of this. When you look at multi-asset, I would like to say that these benchmarks, you cannot paint all of the schemes with the same brush. You have to actually take that particular scheme and then look at the objective of the scheme and then look at what is the benchmark that they are using and whether that is the right product for you in terms of matching it with your risk profile. So every scheme which is there in the multi-asset category will have a different benchmark. It depends on the percentile exposure in equity, percentile exposure in precious metals, as well as percentile exposure on the debt side. So please have a look at the benchmarks and then try to select a scheme which fits your risk profile.
Okay, point taken, and that is the reason why it would be important to compare it with the benchmark and not category-wise or different funds as well. But you know, Amit, the general idea is that multi-asset funds, they're fared better than balanced advantage funds, which manage their assets between equity and debt dynamically. Across time frames, that's the idea generally. But what is your take here? Should an investor prefer multi-asset over balanced advantage funds? List down some of the reasons for us. What should be done when we invest in multi-asset funds, and why should one not invest here?
So the idea of a balanced advantage fund and multi-asset is similar. However, in a balanced advantage fund, your exposure to equity can be significantly higher compared to a multi-asset fund. So when the markets are good, Sonal, when you try to look at the league tables, when the markets are doing new tops, you will always find that a balanced advantage fund will look smarter than a multi-asset fund. When you are actually happy, when you look at your returns on a balanced advantage fund, but equally you can frown when the markets actually go down. All these three asset classes in a multi-asset, they do not move in tandem, whether it is equity, whether it is debt, or whether it is gold. And therefore, if you want to lower the volatility in your portfolio and still make a decent return, I think a multi-asset over a long period of time does make sense over balanced advantage funds. Second thing, what I have actually seen is that people look at balanced advantage fund as investors are in a confused state as to where to invest in a new top market. So most of the people, they go for balanced advantage funds because they want to have an exposure in equity, but not 100%. Although the objectives of both the categories are more or less same, but the choice is a subjective issue. And if you are looking at reducing your standard deviation in your portfolio, reducing your volatility in your portfolio, then a multi-asset fund actually will be a better choice compared to a balanced advantage fund after looking at the risk profile of the individual and also the diversification. For example, if you have a lot of gold with you, invested directly in an ETF, or you have jewelry with you, then probably a multi-asset will not make sense because then you are taking an extra exposure in gold. But at that time, balance advantage might make sense. But if you want a flavor of all the three, like you have a mobile range, wherein when you look at your mobile, you have got these antennas which come up, and the stronger the range, the better the clarity. So these 3-4 things what you have on the network, Sonal, are actually your asset classes, which is equity, debt, precious metals, and in some cases REIT for multi-asset. So it depends on the objective, it depends on the risk profile, and it depends on the diversification what an investor actually needs.
Okay, all right. Amit, just a quick last question with regards to multi-asset funds. Do these funds have a tax advantage as well? For example, how are the returns here taxed? Have we seen a big change or flow into multi-asset funds post the change in debt tax regime which has taken place? Is the fund house or the fund manager an important metric as well when one looks at investing into multi-asset funds?
So when it comes to taxation, I think one should not look at investing based on taxation. He has to look at investing based on what output he needs from his investment and what kind of risk is he going to take. When it comes to multi-asset, as I said, there are two types of taxation which multi-asset funds or schemes have. Some of the multi-asset schemes do have equity taxation, where you have got 10% long-term and 15% short, while some of the funds have got debt taxation with indexation. So if your multi-asset fund generates, suppose, a 7 to 8% compounded return over a 3-year period, and if you have a 5% inflation index over that 3-year period, then you actually pay tax only on the 3% extra which you have made on the index, which means you will pay 20% tax of indexation on that 3% alpha which is generated on the inflation index. So you'll pay 0.6% tax, while if that had been an equity taxation and you generated 8% and it was long term, you would have paid 80 paisa as your capital gain tax. So there are advantages of debt taxation if you hold on for post 3 years in your portfolio because indexation kicks in, or if you go in a multi-asset fund with the equity taxation and you are exiting after a year, then you can have a long-term capital gain of equity after exit of 1 year.
Okay, all right. Amit, always a great chat. Thank you so much for joining and explaining to us what really multi-asset funds look like, what are the benefits here, and what should be kept in mind while investing here as well. We'll take your leave on this note, and that's all we have on the show. But do remember to email us your queries and we'll address them with our experts, leaving you with some market opinion from Sanjay Mukim, who's the strategist, head of India Equity Research at JP Morgan India. Stay tuned for Closing Bell to take you through the last hour of trade.
Income levels are still relatively low and it needs to continue to go up. So there's a potentially lot of upside. But when you do go and visit people and talk to people on the ground, you do realize that over a course of time, there has been significant improvement in the social safety net, in the facilities that are available to the bottom of pyramid people in India. So on a long term, you always continue to have long bias to Indian stocks, especially those focused to the domestic economy. In the near term, you will have to wait for this revival, which also we think is actually underway. Now, historically, you've seen that the private sector banks have always gained market share and done 6 to 7% higher than system loan growth. And the PSU banks are also competitive for a variety of reasons. So it will be an interesting next few quarters to figure out how these market share changes happen and whether a large number of financials can continue to outgrow the system. We are in the camp that it's a bit too early to look at Indian IT companies on the basis of their correction or on the basis of a valuation anchor or any of that sort. And some of the mid caps or smaller names are also trading at very elevated valuations as well. So you're likely to see earnings misses, downgrades, and valuations again are not at supportive levels to our mind. There are signs that there is some slowdown, maybe not as rapidly as you would have expected, but the direction is softening a little bit. On growth, on consumption and so on. But the feedback from people, the large companies, the BFSI, retail, is still very cautious. So we still expect that the IT universe growth of demand will come in weaker than people's current forecast.